Welcome, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals, nor should you consider anything we say financial advice. We share our own thoughts and opinions so that you, the viewer, can form your own opinions and make your own financial decisions. Today is Sunday, April 4th, 2021, and this is Blockhead Traders Weekly. This week it's just myself, Sprocket888, and we're going to be covering position sizing. But before we get into the topic of position sizing, I want to put a plug out there for our Discord channel that we run. A Discord channel is open to everyone, and you can find a link in the description below. It is a great way to ask interactive questions with myself and a few of the other Blockhead traders. We're usually in there most trading days and occasionally in the evenings and after hours. A lot of times when I'm getting ready to put a position in, I'll go ahead and make comments in the Discord room about positions I'm considering, things I'm looking for. I also really like to interact with the traders that are in our Discord room, answering questions or anything that's on their mind when it comes to the financial markets and things they might be wondering about. I'll do my best to offer any guidance or assistance in that respect. Make sure you check out the link in the description below and join us in the Discord room and say hello this week. So this week's topic is position sizing, and you might ask, well, what the heck is position sizing? And I would like to tell you that I consider position sizing one of the most important topics when it comes to managing your portfolio and deciding what trades to enter, how much of the trade to enter, how many trades to put on. Basically, position sizing, in my opinion, is the key to being able to sleep at night and to be able to keep trading as days go on. One great indicator of if your position sizing is not correct can be if you're losing sleep at night, or if you're constantly deciding that you have to, pull out your phone and check the price of the market or check the price of your share. If you're real anxious about it and real antsy about it, chances are your position size is probably too large. I would guess that the too large of a position size is probably the number one mistake that most traders make. They get real convinced that their theories are correct and their thoughts are correct, and it might cause them to place a larger bet on a particular underlying, a particular direction than they would otherwise normally take. I know for myself, pretty much if I look back at the past year of my trading, in all of the large trades that I would consider were a mistake, or basically any trade that I would look back and say, man, that trade was not a good trade, almost every single one of them was where my position sizing was probably too large for my account. And so what I've kind of done over the past year of experimenting with this, reading about different resources online, was I basically came up with my own spreadsheet that kind of helps me determine what is the correct position size that I should be taking based on my account size. And I paired that with my trading journal to basically keep track of all of my open positions, and it will pay attention to the open positions and look to see how much capital might be left to trade with and where I might allocate those from a defined risk to an undefined risk. And I keep all that on a local spreadsheet, but I thought it would be a great thing to share with you guys out there in the community. So this past week, I transferred all of the formulas and structure and cleaned up a few things, and I basically made a Google Doc sheet. And you can find a link to this Google Doc sheet in the description below, and you should be able to open it, and you should be able to save it off on your own Google Drive, download it to interact with on your local PC. The copy that I'm publishing out there is read-only, so you're going to have to save it off in your own area so that you can use it. Feel free to tweak any of the formulas. They all should be visible. They all should be there. But in this episode, I want to take you through that spreadsheet so I can kind of describe what the different sections are, how I use them, what you might want to tweak, what you might not want to tweak, why things are there, why they're not there, why I left this out. Yep, let's get right into the worksheet. So I have pulled up here the trading worksheet that we have, and there are basically two tabs that are where you're going to spend most of your time. The first one is the position sizing tab, which is what I have pulled up here right now. I put the zoom at about 200%, so hopefully you can read that. And I'll kind of scroll around a little bit on there. But I want to talk through the position sizing sheet first. And this is one of kind of the general summary of where everything is. And you can kind of tweak some of this for your portfolio size. Right now, the first section in here is basically net lick. This stands for net liquidity. You might hear it referred to as net liquidity on some brokerages. Net lick is often what it's abbreviated as. And it basically means if you were to empty your portfolio today, what is the value of that portfolio? And everybody's going to have a different portfolio size. When I first started, my very first portfolio, I started with about $2,200. And you can kind of tailor this size for whatever the portfolio is that you have. And a lot of the trade sizes and stuff will kind of be modified off of that. Some of them here, you have to do a little bit of modifications, but right now this is set up for about a $10,000 portfolio. If you had a different size portfolio, maybe you're 5,000, it'll change some of the values down here. And we're going to talk through each of these so you can kind of understand how to set this page up for your particular portfolio size if you want to use it. And what this allows me to do is see, how much money do I have left based on the trades that I've made to make future trades. So the first category, or the first line item below net lick, is percent utilized. Okay, this basically means of your net lick, how much of this value do you want to allocate to trading? Now, a lot of sites will kind of reference 50%. You should never allocate more than 50% within your trading strategy. If you watch Tastyworks or a lot of the other premium selling channels, very frequently they will talk about never use more than 50% of your buying power. And I completely agree with that. But as I walk through how I determine what a trade size is, I basically kind of overestimate the size of the trade. And so because of the way that I get into the actual trade size, I personally set this number to 75%. And you'll kind of see what I'm talking about a little bit later on in the video. So this line item of BP free, this basically says, if you were to use 75% of your allocation, your trading account would have about $12.50 left of buying power that you basically would not be utilizing. If this, was a $10,000 account and you use 75%, you'd have about 2,500 of your buying power would be free. Now, I have the next 4 rows here are basically kind of related. The first 2 here are all about defined risk trades. Now, a defined risk trade is where you basically, when you enter the trade, you know your max loss and you know your max gain. You cannot exceed your max loss and you cannot exceed your max gain. So these are things like iron condors, put verticals, call verticals, basically anything where your entire risk is completely defined upon trade entry. And this is the percentage that you will allocate to that particular trade strategy in the portfolio. And I'm going to go to another table in just a second. The 2 rows here are basically the same thing, but for undefined risk trades. So these are strangles, straddles, naked calls, naked puts. Then this is the percentage that you should be allocating towards them. And then the value below them is basically your dollar amount for each of those trades. So there's another tab here called rough numbers. And these are just kind of my own assessments of about what these percentages would be based on your account size. So for example, in the 2K to 5K account size, you're probably going to be doing defined risk trades around a 5% level. And in my opinion, this account size is not suitable for undefined risk trades. So I would highly recommend avoiding undefined risk trades if your account size is in the 2 to 5K range. Basically, the reason I say that is the amount of capital that you would have to allocate to that undefined risk trade would, just with one trade, outsize your account. You'd put too many eggs in that one basket. When you get into the 15 to 25K range of an account, you're probably going to scale down your defined risk trades to maybe about 4% of your net lick. This is probably the value of which I would say you might want to start or try undefined risk trades, but I really wouldn't advise doing very many. Maybe one, maybe two, just to get kind of the flavor of it. But the reason is because of volatility expansion in naked trades. You can really consume a good chunk of your portfolio. So you can see in this range, you're probably going to be allocating 10% of your portfolio to one undefined risk position. And, I'm just not real comfortable with that personally. So, try it out, one or two in this range, but this is probably not the range where you're going to be putting many undefined risk trades on. The next value, if your account is somewhere between 25 and 50, your defined risk percentage is probably going to come down again. And your undefined risk is also going to be coming down. To me, the 25K threshold is really where the undefined risk, that's really where it becomes more okay and appropriate to populate a lot more of your trades in an undefined manner. I prefer undefined risk trades. They move a lot faster. They basically decay a lot more from a premium selling perspective. You have a lot more flexibility in your management of an undefined risk. In most defined risk trades, it's a very binary trade. You put it on and you're either going to win or not. There's really very little adjustment that you can do to that trade, and you're probably not going to be able to roll it forward in a month. In an undefined risk trade, you have a lot more management options, and you likely can keep that trade rolling from month to month to month if it's not quite hitting your targets. Lastly, if you happen to be fortunate enough to be in a 50 to 100K range account, you're probably looking at around a 1% size for your defined risk and maybe around a 2.5% size for your undefined risk. Anything above 100K, and you're basically going to keep scaling down your defined risk and keep scaling down your undefined risk. And what that really allows you to do is make good trades that are going to return a lot of capital, but because your net lick is so much higher, you're able to scale down those percentages to play more numbers. And when it comes to premium selling, it's all about the numbers game. So we've talked in past videos about the probability of winning or the probability of a particular trade finishing at a price level. And really what makes that possible is enough occurrences statistically to make that come true. So the more occurrences that you can generate, the closer that you are going to come to those theoretical probability numbers at a high level or a macro scale. So let's go ahead and assume that we have about a 25K portfolio, just because I want to put a couple of undefined risk trades in there and I want to show you how that kind of works out. So we're going to go back and we're going to set our values to 25K, and we're going to go ahead and utilize 4% and 10% numbers. Okay. So we're going to say we have 25K as our net lick. We're going to utilize about a 4% defined risk trade. We're going to go ahead and put a 10% undefined risk number in here. Okay, so now you can see that our defined risk trades are going to consume about $1,000 when we size them up to about 4%, and our undefined risks are going to consume about $2,500. The reason that I'm doing this is basically to accommodate for volatility expansion, which only exists really in the undefined risk trade. And what I mean by that is basically, as volatility will expand, your buying power reduction will change over time in an undefined risk trade. In a defined risk trade, your buying power reduction is static and fixed at the time you enter the trade. The next two columns are really about what do you want your portfolio composition to look like? And this is really all about your risk tolerance. So right now, this portfolio is set to about 60% defined risk trades, 40% undefined risk trades, which is about 11 defined risk trades and about 3 undefined risk trades. I think I'm going to tweak this just a little bit here. So, like I said, at this portfolio size, you're really just getting into the undefined risk trades, and so I kind of like this value, maybe two undefined risk trades in the portfolio, and then the rest of the trades are going to be, defined risk, so about 13. Uh, the next value here is the delta target. So this is the portfolio delta, and I'm not going to get into that too much in this video, but this is if you look at your entire portfolio and you basically do what's called beta weighted against an index. A lot of times the SPY is used. So what this is doing is it's normalizing all of your positions to a common denominator. Typically, the SPY index is used because it's so broad-based and covers all of the different categories. If you had a very tech-centric portfolio, you might beta weight against, QQQ, depending on your portfolio. But for most people, beta weighting against the SPY is perfectly fine. And what the delta target is in your portfolio, your portfolio delta, your holistic, if you add all your positions together, what's the delta number of your portfolio as a whole? And this value is plus or minus, in this case, $50. So this basically means you can consider your portfolio delta neutral as long as that value is less than 50 delta and more than negative 50 delta. Anytime you start getting outside of that, your portfolio is no longer really going to be considered a delta neutral portfolio. You're probably going to lean, more bullish or more bearish, depending on whether or not that number is positive or negative. So in this case, if you have a negative delta, then basically your portfolio is arranged to be slightly more bearish. If you have a positive delta, your portfolio is going to be arranged to be more bullish. And for the most part, I try to maintain a delta neutral portfolio. What that allows me to do is really not see very big P&L swings during the day. So the more neutral you are in your portfolio, the less affected by the price changes up or price changes down that you get. So it's more pure theta decay that you start seeing in your portfolio. So as one day goes by, if you're delta neutral, your gains should be much closer to your daily theta number for your portfolio. If you're not delta neutral, your daily P&L will basically be more heavily impacted by the movement of the underlying stocks. So this is roughly about 0.2% of your net lick. So of course, if you have a much larger portfolio, delta neutral is a wider range from zero. And the smaller your portfolio, the closer to a zero delta that you want to try to maintain. And really, this is just a guideline. I don't really start getting to the point of wanting to correct my deltas until they're like more than double this value. So in this particular portfolio that I have on the screen, I wouldn't really start trying to make corrections to my portfolio until my delta was basically 100 or more. So basically twice this target. And even then, depending on the market conditions, I may or may not care as much about that. The daily theta target. So in premium selling, basically what you want to do is sell a lot of premium, and every day you're just collecting on the decay of that premium, and that's theta. And so basically your portfolio theta, if you add in the theta numbers across all of your positions, I personally try to target about 0.2% of my net lick in theta decay. So if I take all the positions that I enter, I like to try to see my theta decay around a $38 mark. Now, and again, this is a guideline, because what will happen is you can open up a bunch of positions. Let's say, I opened up 4 or 5 premium selling positions, and my daily theta number, my portfolio theta, might be $20. Okay, now I'm not going to worry too much about that, because if I just open these positions, likely it means I'm, 45 days away from expiration. And what you'll see is that theta number will kind of increase the closer we get to expiration. So, while I might have a $20 daily theta today, in 2 weeks, that might be a $40 theta decay number. And so, the average of that over the lifetime that I'm holding these options, um, you know, I'm hoping to come out around $38 in daily theta decay. So again, this is just kind of a guideline um, to say, hey, where am I in my portfolio health? And the last thing I have in here is super rough estimation about the expected income in a month from theta decay. And you really, this isn't super exact. In fact, over the past year, I would say it's not that far off, but it's not like you can't bank on this. And all this basically does is just take the number of days in a year, multiply out, $38 a theta decay every day of the year, divide it by, each month. And so in a $25,000 portfolio, following my trade size rules and my entry rules and all of that stuff, I might be close to around a 1K monthly gain or monthly income from premium selling over the course of 12 months. Okay, so if we come up here to this area here, you'll see 4 rows. It says week 1, week 2, week 3, week 4. So we haven't really gotten into my trading strategy, but roughly I work on monthly cycles. It's about a 4-week cycle. And in week 1, which is roughly 46 days to the next monthly expiration, I will begin to start selling premium for that particular month. I typically would try throughout that week to sell roughly 45% of the trades that I hope to open that particular week. And week 2, I'm still going to be opening positions because really the key to opening positions is doing so around the 50 to, maybe 35 days to expiration mark. Any time in there is usually an okay time to open a position. So in week 2, I'm going to try to open up another 45% of my allocated trades. And if you notice, that basically leaves about 10% of the trades that I wish to allocate out. So I kind of have 10% of the money that I'm going to allocate held back. And this is not of my net lick. This is basically of the 75% that I said that I'm going to use to trade with. And what I reserve that last 10% for is if I want to make any delta corrections to my portfolio, I basically utilize that last 10% within the last 2 weeks of that expiration cycle, where I might open up a trade specifically to counter some sort of delta activity that's going on in my portfolio. And what the rest of this columns here do is they basically take this 45% and they say, okay, well, what this means is you're trying to allocate out about $8,400 based on the numbers of this sheet. That will probably get you about 6 defined risk trades and almost 1 undefined risk trade, which makes sense because, the targets here are about 13.5 for a monthly cycle and about 2 for undefined risks for a particular monthly cycle. And so, that's roughly the 2 trades, and I don't really have enough left to do a full-size undefined risk trade to counteract the deltas. But this is basically, my rough guidelines of in week 1, probably going to be looking to open about 6 trades, maybe 7, if I happen to include an undefined risk, and week 2, same thing. So the next thing, or the last thing on this sheet, is this little kind of pivot table area down here. And what this pivot table is doing is it's basically looking through my trading journal, which is another sheet that we're going to go through, and basically saying, hey, right now, currently open, you have this much trade size open for defined risk. So I currently have, $328 of trade size of defined risk and about $430 of trade size in undefined risk. And it basically reflects these numbers into these two rows right here to let me know, hey, how much capital do I have left for deploying an undefined risk and defined risk? So right now, given all the values of this sheet, I have about 13K of defined risk capital that I can still utilize to open new positions, and just shy of 5K of capital to open up new undefined risk trades. So what I'd like to do now is then take you to the trade journal, and I'm going to walk you through the different columns on the trade journal, and then we're going to go ahead and enter a couple of trades and just show you how they reflect in the summary sheet so you can kind of utilize them. So right here is my trade journal, and I've kind of cleared out all of my values. I have a couple of dummy values in here to show you how they work. Up here at the top is a cumulative total, basically of how many, it only counts the closing trades, but it'll tell you, how many closing trades did you win, how many closing trades did you lose, how many trades have you made, the dollar amount associated with each of those, and this one becomes the win percentage that you have based on the trades you entered. The way I've structured this trade journal is there are columns that are kind of in a light gray. These are basically columns that you don't need to touch, okay? These are auto-calculated. You can go ahead and look at the formulas on how I calculate them, but basically they're not values that you need to input into the sheet. Anywhere that there's basically not gray is an input that you will be providing as you kind of fill out your trades and utilize this trade sheet. So let's go ahead and talk through some of these columns here. Sequence number, this is really just a way to order. So if you start sorting by each of these different columns, you might not be able to get them back into the exact order at which you entered them. So this row is just simply a sequence number. So if you resort this by the sequence number, it'll put all your trades basically in the order that you enter them. Account column. So if you happen to utilize more than one account, you can kind of keep track of, which trades are in which accounts. So for me, when I first started this, I basically had my main brokerage account, and then I had an IRA account where I was also making trades. And this will allow you just to specify it. You can leave it blank. It's not referenced in any formulas. It's just for my own kind of processing some of the data fields that I put in here. This one, super obvious. This is the symbol that you entered the trade in. It's not used in any of the formulas, but it basically lets you know, hey, what did I make the trade in? Sector. This is one that I added because I really wanted to try to keep track of how weighted in different sectors I was. I had a couple of months in the past that didn't go as well as I had hoped a few times, and I realized, they happened to be months where a lot of my investment concentration was all in one particular sector, and that sector didn't do very good that particular month. So I write down the sector that the company is in this field to basically monitor how diversified I am simply by the sector category that the underlying is placed in. So kind of optional, although I do think it does have some value. The first field that you're going to fill in here is opening date. This is the date that you opened the trade, the date that the order was filled, what have you, but it's important because it is utilized in some of the calculations. Close date, very obvious. This is the date in which you closed the position. Now, I want to keep in mind, we're going to get to rolling trades. Basically, I don't close my trades until I am done with the position. So if I have an underlying, say in Macy's, and I roll that from one expiration month to the next, to the next, to the next, I don't actually fill in a close date until I am done with that position and I completely close it out. So the next field here is original expiration date. Now, this is where basically the first premium that you sell, what is the month that it expires? That's what goes into the original expiration date. That will automatically populate the current expiration date. It will make those match. Okay. Now, when you get to a place where you roll a position, basically what I do is I only update the current expiration to the new monthly expiration. So for example, if I was putting a trade in here in, say, Apple, and let's say I put this trade in, let's say I did that back on March 15th. And it was originally an April expiration, but I basically rolled it to May. I would fill in the May expiration here. If I rolled it to June, I'm going to put in the June expiration date. And what that's going to do is basically say, okay, how much time do you have left in those options? What are the days to expiration? How many days has it been in play? So the days in play go from the opening date. The days to expiration basically go by the how many days to the current expiration field. So when you roll it, that number will kind of keep going up. And then as you keep going, your days in play will keep going up. I do this because I like to reflect back in particular trade months. How long did I hold this position? How long was this thing around? When did I open it? All of those things. And both of these fields are important to that value. The next thing is the quantity. So quantity here basically means what is the share of contracts that you currently have open. And I'll get into a little bit of that in just a second, but it's not how many you have traded, it is how many that are currently open. A lot of times those will be the same number, but if you do like rolls or you add positions later, that quantity might change, but it's always the number of contracts that you have outstanding. The next ones are you would basically fill in, your long put strike if you have one, your short put strike if you have one, short call strike, and long call strike. So that really depends on what are you trading. If you're trading an iron condor, you're putting a number in all four of those. If you're doing a naked short put, you're only going to have a value in one of those. If you're doing a call vertical, you're going to have a value in both the call strikes. So that will automatically fill out your break evens. It'll populate what is your break even price based on where your strike price is and based on the premium that you collected, which we haven't got to that column yet. Next column is current stock price. Right now, this does absolutely nothing. And moving it to Google Sheets, I thought this might be cool because I can add a ticker price lookup. So we could potentially get kind of more live pricing on an underlying based on the ticker symbol here. But right now, this does nothing, so I would just skip it. Here is where you define your trade type. You have to manually specify whether or not it's a defined risk or undefined risk. And this column is what this main summary sheet is using right down here to say where is your money allocated. These next two prices, so when I trade undefined risk, I basically set myself a bail price. So in a defined risk trade, to me, these values mean absolutely nothing, because in a defined risk trade, for me, it's very binary. I'm in it and I'm either going to come out a winner or I'm going to come out a loser. And there's really not much management. There's no, early bail that I'm going to take on the particular trade ever. I'm probably going to let this thing ride out to 21 days to expiration or 14 days, something like that. Now, in an undefined risk, I basically, this is where these two are important to me, because in an undefined risk, I need to know, hey, where's the value where I'm just going to pull the ripcord and say, enough is enough, I'm out. I'm done. The trade didn't work out. I'm going to take my loss, get my buying power back, and I'm going to move on to the next trade. Now, for me, that is roughly 2 times the credit received. So, for example, if I make a trade for $1, I sell some naked option for $1, I will let that trade go to negative $2 before I bail. Okay. So that's basically the strike price minus 3 times the premium collected. So it's basically $3 under the strike price that I took. plus the premium. So in the formula, you will see times 3. So it basically takes the premium that I collected, multiplies it by 3, and then pulls that down from the strike price. And that is the price at which I will bail. And we'll get to that as I pull some stuff up when I'm defining that defined risk. We'll take a look because that's how I key in the buying power reservation. So the next column is BP reserve. This means how much buying power am I losing in the trade? So every time you make a trade, your broker is going to hold back buying power from you. And you need to fill this in yourself. And this is where I get kind of conservative when it comes to the undefined risk trades, and why I actually am more comfortable with a 75% allocation. It's because when I set my buying power reserve, I set my BP reserve at my max loss or my bail price. And you'll see when I go through one of these where that differentiates, okay? For a defined risk trade, this is always going to be the width of your strikes. So when you're buying one and selling another, whatever that dollar amount is between those two strikes, that's really what your buying power reserve is. So in a $5 wide iron condor, you are tying up $500 in buying power. The next column here is the original credit and debit received. So this sheet will track debit spreads. It also will take care of credit spreads. I primarily use them for credit spreads because that is the type of trading that I do. And really all I'm going to do here is put in the fill price of my trade when I opened it. That is what the original column is. So this one only ever has one value. And what I do when I enter this is I basically put the credit received times the number of contracts that I did. So in this case, it was 1. I don't use this value because when I go to roll, or maybe I'll do like my quantities could change over time. So in all of my credit and debits, I basically embed the quantity traded within the formula. Now, the next column is going to be rolling credit or debit. So basically any adjustment that I make to a trade after I open it goes in this column. So if this particular trade I ended up rolling for next month, and my roll netted me maybe 25 cents a contract, and I rolled my one contract, I'm basically going to put 25 cents here, okay? So this only gets populated if I make a trade or if I add a trade to the particular row. That will automatically update my total credits or total debits that I have on the trade. Additionally, this will set my trade size. So the trade size is how much risk I'm taking on. And this trade size is what's used in the position sizing summary. So for this particular row, it takes the buying power reserve, it reduces that by my total credits or debits to give me my trade size. So in this case, I have lost $500 in buying power. I had a 95-cent credit, which basically makes my trade size $405. Now, I also automatically populate my close price target. So to close this particular trade out, I'm looking to do so for 48 cents. And that is because when I run my trades, I basically take profit at about 50%. So my target of closure on any trade that I open is 50% of the credit that I received. So in this case, I received 95 cents credit. So I'm going to look to close out for 48 cents credit, which will give me a 48-cent profit or $48 profit. I always put a worst case price in here. And worst case basically means how much am I going to close this trade out if it goes to my bailout price. And that just kind of keeps me, hey, I'm probably going to close this thing out somewhere between here and here. So this column is the price at which I actually close it out. So when I go to actually close a contract out, I'll put in the closing fill price here. I also put in the date of the close, and that's going to update, the gain loss. So until that happens, it basically, there's hey, my worst case situation here is I'm going to lose $190. My best case is I'm going to gain $47.50, and that's based off of my projected close price target and my projected worst case target. Now, if I actually end up closing this position for, say, 55 cents, I'm going to put in 55 cents times 1 because it was a one contract trade. My target was 48. I closed it to 55. You'll notice these didn't update yet. And that's because that's keyed off of your closed date. So if I come in here and I actually fill in my close date, this is now reflecting the $40 that I actually made. So because it's actually done and closed, my worst case is $40 profit. My best case is $40 profit because it's all done. Now, the very last column is trade notes. So this is really for me to just jot down anything that I might want to review in the future. No formula uses this. So this is the worksheet kind of in its entirety. You can access it and check it out. The next thing I want to kind of do just briefly is go through a position sizing for a trade, an undefined risk and a defined risk trade, just to show you kind of how I decide to do that based on the guidelines that we have here. So what we're going to do is we're going to go to my trade window, and we are going to go ahead. We're going to put a defined risk in Amazon and undefined risk in Macy's. So we're looking at about $1,000 defined risk trade size and about a $2,500 undefined risk trade size. So keep that in your head as we move over to looking at the particular underlyings. Okay, so we're going to look at Amazon, and we're going to look at the option chain. And the first place that I'm probably going to start out on the option chain of Amazon is I'm going to kind of look around 25 delta. That's usually where I like to try to start looking. I'll go as high as a 35 delta at times, and I'll go kind of as low as about a 16 delta. But let's go ahead and take a look at the 25 delta, which will be selling the 29.60. Look at a $5 wide here first, which will be buying the 29.55. And what you can see here is we got about a $500 risk, or sorry, $500 buying power reduction. And what I like to see is I like to see my credit to be about 30% of that reduction. So in this case, I'm really looking for about $1.60 in credit, which I'm not picking up here at the 25 delta. So the one thing I can do is I can maybe look to extend the width of my vertical, and that would be basically be coming out and buying the 29.50 as protection. This is now a $10 wide vertical, and you can see I'm collecting 242, which is about 24% of premium on my buying power reduction. And that's really not really where I like to be. So let's kind of come up to let's come up to a 30 delta, and let's see where the 30 delta is at. So the 30 delta will basically be selling the 30.10 put, and let's look at a $5 wide. Okay, perfect. So right here, we're looking at a $5 wide spread, and it's collecting $1.72. So that is over the $1.60 that I like to target. So I'm okay with this spread. Now, I have about $1,000 trade size to work with. And this trade size is basically going to be $5 minus $1.72 because we're collecting some credit. So I kind of have a couple of options. I can extend the width of this to probably around a $15 wide condor, or $15 wide vertical. So let me take this to a $29.95. So you can see this is 15, collecting $4.52, which meets those criterias. And that would basically, if you take the less, that's going to be just a hair over $1,000 in trade size because we take our 1,500 buying power reduction. Then we take the 452 credit, and that is the trade size that we have. If you remember, we're targeting about $1,000 trade size. So the other option I could have is keep it a $5 wide vertical. So let's go back to the 3005, and then let's boost the number of contracts to 3 contracts. So now we're getting this 1,500, and then we're collecting $5.16. So I kind of tend to like this trade a little bit more. So this is the trade that I'm probably going to make. The markets aren't open, so I'm not really going to make this trade, but let's go back to the worksheet and let's enter this information. So let's remember the 3005 and 3010 strikes. So we'll go back to our sheet here, and we will open this one on, normally you'd wait till you get a fill before you populate this, but say this is getting filled on Monday. We are looking at a May 16th expiration. So you can see it automatically populates that to the same date. That's 42 days away. Basically we'll be in play for a day. We're going to do a quantity of 3 because we're going to do 3 of those. Our long strike was 3005. Our short strike was 3010. It was a defined risk trade, and the buying power reservation is 1,500 for the trade, and the original credit and debit. So if you remember, we were picking up $1.72 contract, and we did 3 contracts. So you can see that, remember, I told you I put my quantity here just in case for some reason I'm changing the number of opens. So right now that does match the earlier quantity, but it doesn't necessarily all. And you can see right here, we got a trade size of about $1,000, which is our target. So this is great. This is wonderful. And you can see that our, best gain is going to be about 258. That's the 50%. If we were able to close it out at 50% profit. Worst case is if it goes all the way below our protection leg, we're basically looking to lose about a little over $1,000 on the trade. So that's great. I like that. That's wonderful. We're going to go ahead and keep that one in there. And what you can see is it's really important to actually make sure your trade sizes match your trade size target. So as I mentioned, it's all about the law of probability and the large numbers. So generating a large number of equally sized occurrences will help the statistics play out for you in the long run. Okay. So let's go ahead and I'm going to show you how I size up undefined risk trades. And this is a little bit different than a defined risk trade, and you'll see what I'm looking at. So we're going to go ahead and we're going to look at Macy's as an undefined risk trade. So let's go back here and let's look up Macy's. Let's clear this out. Now, this is a little different. So, I like to go, same rules apply on the deltas. I like to start out around a 25 delta. I'll go as high as a 35. There's also the 16 delta. So looking at the May put expirations of Macy's, I can see, we're looking at a 38 delta, 28 delta, 19, 12, 38. That's too high for my taste. So I wouldn't sell the 38 delta. You can see a good bid-ask spread here. So I'm going to go ahead and take a look at selling the 28 delta here of Macy's. Okay, so right here we're looking at about a 70-cent credit for a $225 buying power reduction. This meets my 30% target. And one thing that I would add is I would never, ever, ever put in this order at 70 cents. And the reason for that is if you pay attention, the bid ask, this 70 cents is the bid price. The ask is 89 cents. So if I was to actually be putting in this order, I'm going to go ahead and bring this thing up to at least the mid price when I enter the order to get a better fill. A lot of times what I'll do when I'm trading naked is I will actually bump my target maybe a couple of ticks past the mid price, really depending on how liquid the stock is. This is hard to gauge because we're after hours, and this basically is a snapshot of the close on Thursday because Friday was a holiday. So I'm going to probably start more at the mid price, but I can tell you the 70 cents, that's already at my 30% target of, premium collected for buying power reduction. Now, here's where it gets a little bit different when I'm setting the position sizing here. Okay. So let's go to the risk profile trade. And basically I'm collecting $70 on this trade. And so what I'm going to do is I'm going to come up with a bail price of usually twice the credit received. So if I'm collecting 70 cents, I'm going to come down to look at my strike price of where is my blue at about $140. So right here is $11.90. You can see that's $140.44. So what I'm going to do is I'm going to set my price slice to $11.90. Okay. And what I see here is my buying power that will be consumed if the price is at $11.90 is about $500. Okay. So this right here is the value that I'm going to put in for my buying power reduction, even though at the current price, it only consumes $225. I like to set aside the worst case scenario when it comes to my buying power reduction. And this is why I am more comfortable with my allocation that I mentioned earlier at 75% versus what a lot of other people will tell you to do 50%. The reason other people tell you 50% is a number is because they do their calculations off of where the number of buying power reduction is today. For undefined risk trades, those can increase as the price falls. So because I'm padding that number with extra bits, extra protection, I'm okay using a higher buying power allocation of my capitals, because if I'm setting aside 75% to deploy, I'm actually calling a bunch of capital used in this trade, even when it's not used. Hopefully that kind of makes sense. But in my opinion, it's a slightly more conservative way to view your buying power reduction. What I found over time is when I'm actually deployed at what I have set at my 75%, when I actually look at my brokerage account and my brokerage statements, I'm closer to a 40 to 50% capital allocation at any one given point in time, which does match the other advice that you'll find on the internet. So that's why that number is a little bit different. And it's all about how you calculate your trade size here. Do you do it based on where the stock is when you make the trade? Or do you account for your worst case scenario? For me, that would be if the stock goes down to $11.90 here. So the next thing I'm going to do is when I get this number, I'm going to increase my number of contracts here to get my size up to about my $2,500, which is the undefined risk position size that we were talking about before. So here we go. Okay, now at 5 contracts here, that margin required is 2,500. But remember, I'm picking up 70 cents on every contract. So that's basically $3.50 or $350. So this buying power would come down by, call it 350. So, 2140. So the problem is if I go to 6, this is basically 3,000, and I'm collecting 420. So I probably could do 5 or 6. I'm going to probably be conservative and say 5. So we're going to put our entry in at 5. And let's go to the sheet. So we're doing the 14 short put, naked short put at a quantity of 5 in May expiration. So we'll come back to our sheet. And I'm going to put this in on Monday. We're going to do the May expiration. We're going to do a quantity of 5. We don't have a long. We only have a 14 short put. And this is an undefined risk trade. The buying power reserve. So remember, we're going off of the 1190 value, which was going to be $2,500 at 1190. And we are picking up at 70 cents times 5 contracts. So you can see right here, the trade size is 29.50, a little bit less than the 2,500. So the flip side was going to 6 contracts would take this to, let's just take a look at it. And if we took that to 6 contracts, well, actually that trade size would be 25.80. You know what? That's probably fine because the fill probably should be better than 70 cents based on the bid-ask spread. Probably we're going to end up getting filled around 78 cents. So that's going to push us a little bit closer to that 25.32. And look at that. That puts my bail price actually a little bit less than where I was originally targeting it at 11.90 to 11.19. You can see that the return on risk in this case is about a 10% return. So we now have one undefined risk and one defined risk trade on. If we go back to our position sizing summary, you can see both of those positions are sized here. And if you come up here, you can see that, we roughly have about $2,700 of undefined risk capital to deploy and about $12,500 of defined risk capital to deploy. So you can see that, that's about what we expected because we targeted almost exactly these position sizes. So we should be able to put on, about 13.5 and 2, and we can have about enough room here for 1. Yep. So this is the position sizing sheet that I put together. Like I mentioned before, and I probably will mention this in many future episodes, position sizing is so important because you might think you're super convinced on a particular direction, a particular price target, what have you. At the end of the day, you really don't know. Unless you have inside information, which you probably shouldn't be trading anyway. You really have no idea what the market is going to do out there. So, it's best to really control that risk by keeping the position sizing constant and letting the numbers work in your favor. So gather enough occurrences, use those occurrences to make sure that the law of probability works out. And that only happens if you can keep the position sizing consistent and then keeping the position sizing on the smaller range. 1, helps you generate more occurrences. 2, it keeps your risk lower, especially if you diversify across sectors. And all of that will really help you sleep at night. You're not going to lose any sleep wondering, oh my gosh, what's happening to my position? Oh, is it going up? Is it going down? What's going to happen with Amazon? Is Jeff Bezos going to do something crazy tomorrow? Or, whatever it is, it's a small percentage of your overall portfolio. And the idea is you go out there and search for many different positions to populate. So the likelihood of all of them moving together is much smaller and the risk is mitigated. And what that will allow you to do is keep your daily P&L much more stable and less volatile. For me personally, I don't like seeing my P&L go way up one day and way down another. I like much smaller oscillation in my daily P&L, knowing that time is working in my favor, and as the theta is decaying, my profit and loss is oscillating, but it's oscillating, going kind of in an upward trend over time. So hopefully you enjoyed this position sizing talk. Like I said, we covered a ton of information, and there could be more questions. So leave a question in the comments below. Join our Discord. I'd be happy to walk through or talk through any questions or concerns you might have. I did just transfer this sheet from my standalone worksheet, so it possibly has errors in it. If you see any errors or any enhancements that we could add, please feel free to DM me inside Discord. Reach out to me. I'd be more than happy to hear what you have to say. What did you find? What's wrong? How can I fix it? Otherwise, linked in the description below for the sheet on Google Sheets, as well as link to the Discord room. And I also post all of my trades on thetagang.com/sprocket888. That link is also in the description below. Hope everybody has a great upcoming trading week. And remember, think outside the block.